want to quickly call upon our speakers onto the stage. It's going to be a fireside chat. Ladies and gentlemen, please put your hands together. Welcome once again back to the stage, Srikanth, Iyer, founder, Homelane, to kindly come and join us, please. A huge round of applause. Also the board member for Thai. Along with him, in conversation with him would be Kanwaljit Singh, founder and managing partner of Fireside Ventures, to kindly come and join us as well, sir. Thank you, and over to you.
Thanks for taking the time, Kanwal. First of all, I'm sure all of you know of Kanwal, but I'll tell you one thing that you don't know about him today before we start, and even he doesn't know that about what I'm going to say just now. So I'll give him like 10 minutes to just sweat a little bit. I'm sorry, 10 seconds. So there are not too many investors who have met me, not once, not twice, but 3 times. When I'm saying met, I'm saying evaluated the business that I was running and passed all 3 times. Kanwal is not that person. So Kanwal met me, I think, in 2003-04 first, which I think a lot of you may not have definitely started up. And I used to run a business called EduRide, EdTech. I think you were at Intel Capital, if I remember correctly. Sorry? Carlyle, okay, Carlyle, one of the large funds. And, it didn't take very long to pass. And, but the rubbing the nose on the ground was with Homelane, which is my current business, because Kanwal met me not once but 2 times and passed both times, and not only passed both times, invested in a different company both the times. So finally I said enough is enough, I have to beat this. So what I did was, one of the companies that Kanwal had invested in, we acquired that company now. So no, Kanwal is an indirect shareholder. So anyway, actually, I mean, first of all, great to have you here, and it'll be really nice to listen to your insights. I've actually got 3 sets of questions bunched into. One is, your investment philosophy, so to speak. The other one is a little more on founders and about what advice you would give to founders in some situations. And the third one is about the future, D2C, AI, etc. So those are the 3 bunches of questions that I have, and I'll start with those. And in the meanwhile, if any of you want to ask Kanwal any questions, please keep them ready. I have exactly 9 questions, and after that I'll quickly move on. Yeah. So Kanwal, everybody talks of successes of their investments, but I've been an entrepreneur for 33 years, and I know that you learn much more from your failures than from your successes. Do you have, let's say, can you talk about the top 3 reasons why founders or companies fail? I mean, we don't talk about failure often enough, is what I feel. Do you have any, like 1, 2, 3, you've seen enough companies now through so many cycles. What are the top 3 reasons why companies actually fail?
Sure. Before I start, one of those few occasions when founder get to grill the investor. So I was warned by Srikanth that this is going to be a spicy session. So I'll try my best to be as honest as I can. So I think the last 25 years that I've been an investor, I have basically seen 3 broad frameworks or 3 broad areas that I would say is possibly what led to some failures, and some very large failures and some early failures. And I'm relating a little bit more to the consumer space. That's been my own love, and I really enjoy investing in the consumer space. I think the core proposition, and we heard about this from the previous panel, and Iyer talked about it, is getting your clarity on what is the proposition, what is the consumer insight, what you're building. I feel that is one of the biggest important criteria to even decide what you want to do as an entrepreneur. And we have seen a lot of cases where you will get swayed by category, by trends, by saying like, this is that new hot thing, I will do one more, and not getting clarity on what differentiates me and what will sustain that differentiation. Because when all boats are rising, you will see a lot of success, and when any roadblocks come in. I'll give you an example. I mean, right now the biggest trend is protein. Everything protein. And I can tell you that a lot of these protein companies may not make it beyond a certain point because there is nothing that differentiates product A from product B. So those are very obvious, challenges that we see, and very often, our lens of investing or evaluating a company is linked to that. I think the second aspect, which is obviously going to be a sensitive question, is the founders. So, we talk about product market fit, we talk about channel market fit. We don't really talk about founder market fit. So, what happens very often is that you will either see a very, very great 0 to 1 founder who's not willing to rise to the next level of what the founder needs to be. I mean, you have been a multi founder, so you've seen that journey. I think the challenge for any entrepreneur is how do you rise from being the visionary to the leader to the manager? And do you even want to be that? And if not, then can you bring in the right organization? Can you bring in the right talent to allow you to do it? Biggest reason for failure is, I would say, that is one of the big characteristics. And the last one, which is again controversial, is the role of capital. I have seen companies fail if they raise too much money, and I have seen companies fail when they don't raise enough money. So we can elaborate on that, but I mean, these
Sure.
are some
No,
of
no,
the
got it. I
learnings.
think, no, valid points. Talking of capital, the one thing that, again, you told me this, is that the Fireside's first check is smaller than the size of your second check to the same founder, which is a bit against the tide, so to speak, because most VCs write their largest check first, and then maybe they do a follow-on, maybe they don't, but they are much smaller normally. So what's behind that thinking that you had over the years?
So I think this is almost like a discovery we made when we got into consumer investing, and I must say that it is probably the most exciting part of my journey as an investor to figure out an investing model which fits in with the rhythm of the company and actually creates value significantly better than the reverse model of putting more money first and then following on. So what we do is we look at a company, we like the founders, we understand the thesis of what they're building. We want to give them enough money to build what we call some form of product market fit. Now that is our first check. Typically, we'll start from $1 million to maybe up to $2.5 million. That's the range of investing. Once we start working with the company, and that is a very important part of who we are and how we engage, we are able to get a sense as early as 6 months and maybe over a 12-month period that this is a company which is starting to show that early signs of success in terms of PMF, in terms of founder quality, how they are building the business. And then we say, this is going to be a winning horse. And can we then double down on this investment? I'm sorry putting Vimash on the spot. I mean, this is a live example. We invested in his company last year, I think 5 crores or 5 crores. And within 6 months, we had put in a check of 30 crores. And 50 crores. I mean, I think we put 30 and they raised some more. But that model has helped us to achieve a few things. One is it gives us great comfort that we are taking our investors' money and putting it in what we have tested as potential thing. Second is we have tested the ability of the company to take less money and be frugal and build it in a certain way to reach that point of PMF. And third is my capital concentration. We see every fund will see some failures. But if I can say that 85-90% of my capital has gone into potentially my winners, then my automatically overall fund performance becomes very different. Rather than saying I have put, in 20 companies, I put 5% each, and whatever is that percentage of failure, then I have to recover that from the rest of it. So it's just a model which works. I think it works great for consumer as an industry. So everybody sitting here, I assume, has an interest in the consumer space. But I mean, I would not do it any other way.
Very interesting. I'm going to move now to advice to founders specifically that you would give. I mean, success rate, we know the success rate of VCs and so companies which get funded also. So when you have a portfolio company which is clearly like dying, It's got a limited runway, say 6-9 months. There's no path to raise. What is the actual conversation that you have with the founder? You must have had multiple such conversations. They can't be easy, I'm sure. So what is it that you talk to them? I mean, how do you even tell them, what you want to say? Because founders obviously are optimistic by nature, and they don't want to see even if the truth is right in front of them. So how do you handle that?
I mean, that is the, I would say, the most emotionally, difficult part of our job, and not the most talked about, because everybody talks of, portfolio, ratio, power law. I mean, you can call it whatever, but you are dealing with real people, you're dealing with real businesses, you're dealing with real emotions. So I think the learning for me for the last 25 years as an investor has been, you have to be honest, transparent, authentic. And you have to have these conversations in a very safe environment of saying, let's do what is best for the business and what is best for you. Does not mean that I can keep putting more money if the signs are very clear. But having that conversation in a safe environment also means you have to be vulnerable. You have to be willing to, emotionally connect with the founder and say, it's not working. Let's figure out, it's not your failure. It's the failure of the business, which could be many different aspects. Therefore, how do we address that? What we have found is some solutions come out of that. One is the founder decides that they want to shut it down because it's not working and they want to do something else. Now, that's the decision which clearly the founder is taking because they have come to this point of conviction. Second option is the founder says, listen, I can continue to build this business. I don't need the money. I will have to redesign my business. In some cases, it's possible, some cases, not possible. But there are lots of cases where founders have said, we will continue to build. We don't need more VC money, but we will build it with a very different rhythm. We'll build it with a very different cadence. And third is we say, can we find a home for this business? And that home for the business, maybe for the IP, maybe for just the size of the immediate revenue that you're generating, or some brand that you have built. And very often, it becomes a great story, which then becomes very positive. I'll take one interesting example. I get killed for this example every time I say it, but I will say it anyway. Naya is a good friend of Shuchi, so I know it'll go back to her. One of my founders, Shuchi Pandya, she was running a jewelry brand called Pippa Bella. This was in the early days of the Fireside Fund. We invested. I was working with her very closely. COVID came, completely killed the business. Not just killed the business because people were not buying jewelry online, but killed the business because all the karigars who were in the little shops around Mumbai, they went home. And we heard about that whole migration mess that happened. So she had no stock. She had no product. So finally we said, let's figure out, there's a great brand. You have done a great job. So we ended up finding a home for that company with Nykaa. So Shuchi got Nykaa, she joined there, went for 2-3 years, then she came and met me saying, I'm done with my large corporate experience, I've learned a lot, but I want to do something else. I want to actually be an investor. Long story short, she's part of my team. She runs our entire fashion and lifestyle and home portfolio. So to me, this is a matter of pride. I mean, she gets embarrassed every time I say it, but it is just the sensitivity with which you handle it. I think that's the most important, and I think our community is not very well trained to handle it sensitively. So we should take some blame for that.
Nice, amazing. Talking of sensitivity, let me move to one of my favorite questions, and a little bit controversial, but then I'll also may get killed for saying this, but what the hell. We see many active founders become super angels. I mean, while still actively running their startup. Does it not worry you that they get distracted? I methey are, after all, raised a lot of money for actually doing a day job. But they sometimes have a portfolio which may rival mini Fireside at some point in time. So what advice would you give to a founder who has raised Series B but may have 50 companies in their portfolio, so to speak?
So it worries me. And no Series B founder who has raised that much money will ask me before they do this. So I can't give them advice. I can just have conversations. I think there are two sides to this. One is they want to give back. I mean, by all means, you invest in companies, you are able to share your learning. So, I mean, I would welcome that, as long as it's not done, in a number which is ridiculous. Second is that there is also learning on the other side. Like the founders who are running a large business can learn from, we talked about AI. I mean, I would imagine that some of the more mature founders in our system have also moved into a little bit of a, I would say, business as usual mindset. So there is some learning which you can, osmosis from the newer founders. I would just argue on 2 points. One is it should not distract you, and that is the most important thing because you're still, responsible to your shareholders, to your other, let's say, ecosystem. Second thing is that don't promise something that you can't deliver. The worst thing that a founder can do is say, I want to invest in your company because I can help you, and then you do 50 companies and there is no way you can help them. You don't even have time to meet them. So again, like Naya mentioned in the previous session, that there are some founders who bring in that value. They are thought leaders. They can be your sounding board by all means. But if you say that I'm going to invest in 100 companies and then I'm going to have value add for you in each company, to me that is inauthentic, and I would be most concerned about that.
You should actually be more concerned if they actually value add because they're actually then spending time in those 50.
They can't. I mean, practically it's impossible.
It is. No, I was just kidding. Yeah. Let me move. I mean, I know time's up, but I'm going to take one last question on D2C because that's the topic, and I think we should talk something on D2C, which I haven't come to yet. Sorry, my bad. But what are your D2C areas that that Kanwal is betting on in the next 12 months, say 12, 20 months? So for the founders here, what are the areas in D2C that you think are going to be hot?
So I'm betting on the entire gamut of consumption. So any area you tell me, and I will tell you where the opportunity is. But to answer it more, precisely, so we are seeing four vectors which are expanding almost, amorphously in a very, very interesting way. We are seeing consumer cohorts becoming far more, I would say, granularized and sophisticated. We used to say urban millennial, now we are seeing Gen Z, Gen Alpha, seniors, women, and each of them has different needs, different aspirations. So you can almost cut the cohorts in very different ways and you can build businesses. Then we are seeing the whole area of channel proliferation. And obviously, when we started 10 years ago, we used to say urban millennial, digital first, Amazon, Flipkart. Today, quick commerce has completely changed that game. Now we are talking about offline, we are talking about distribution, we are talking about omni-channel. So there's a channel vector. Then you have the geographic vector. I mean, the India 1, India 2, India 3, the Bharat story, can you design for Bharat? Can you design for rural India? And that becomes the fourth. And then the sector proliferation, we heard about the whole health opportunity in the previous session. But the minute you start digging into food and beverages, the minute you start digging into personal care, beauty, home, lifestyle, I mean, we have heard so much. I'm pointing to Vimarsh again and again, but building a shapewear business for India where there is no concept of shapewear is a fascinating new idea. And to build a business which is 200 crores in 1.5 years in a category which didn't exist tells you how much of headroom there is to grow. So I'm saying everything is open thing. Health and wellness would be my personal pick. I feel that that's where a lot of consumer money goes, and we heard about the previous panel from all these guys. But I would say if anybody is doing anything in any consumption category, as long as you have the consumer insight, as long as you're differentiating your business from the whatever else is out there, there is an opportunity.
Should we take one or two questions before we close? Yeah. Two questions maybe. Anybody? Yeah.
Hello, good afternoon, sir. My name is Sai Prasad Rode. I'm a founder of Relish Foods. So we are a company which is doing around 8 crore ARR. So when we are at the growth stage like this, and we are approach VCs for investment for growth, there's often a dilemma between profitability or growth. Definitely, we have not reached profitability because we are growing at a pace. How do we address this? What is the right answer? What should we approach when we are trying to raise funds? There's always a conflict in our minds, and we are confused within ourselves.
I mean, short answer is, I think you, at the stage that you are in, and if you are in a very clearly defined category which is showing the opportunity to grow, you have to invest in growth. I think the guardrails to me will be more around the shape of the business. What is the unit economics? If you are a 10% gross margin business and you say, I will keep growing, you will never make money. If you're saying, I'm a 50% gross margin business, but I'm investing behind marketing, I'm investing behind retention, I'm investing behind building the brand, then that is a legitimate way of thinking about it. So as investors, we don't so much look at how much money you are losing on the bottom line because we believe that that is required. We look for what is the overall economic model that you're targeting, why is that differentiated, why is that different from what is out there, and then how does it develop over the future. So a lot of our thinking is more future casting, saying can this business become profitable at a 50 crore stage, 100 crore stage, 200 crore stage, and what will drive that that shape of that particular P&L. So I think the importance of profitability gets into the core business of how you are shaping the design of your unit economics rather than the absolute numbers.
Thank you. Thanks.
One last
I will
one. Please.
conclude with that one.
Hello. Hi. So my question is, D2C typically is seen as something which operates in a lower TAM, so to say. I mean, that's my understanding. So what is so special about this 100 crore as a product market fit number? And because my thesis is that not everybody will grow very high and we are seeking profitability, are there special vehicles, funding vehicles available where the market size would be less, it's a smaller business, profitable, but, potentially ripe for acquisition, but may not grow beyond, let's say, 200, 300 crores?
Can we take two questions at one and you could close?
I mean, if they're related, yes.
Yeah. Do you want to quickly put your question? No, three questions at one would be challenge. We'll do two.
Good afternoon, Kamal. We recently saw Chosen, one of the portfolio entities where Fireside had led the round, along with L'Oreal's Bold also investing a minority. Now, wisdom says generally a corporate VC tends to drag the fundraise eventually. So, are we seeing this as a playbook where you see a financial VC leading the round along with strategics coming in with a minority? Is that a playbook that we are looking at, or is it like a one-off?
I'm going to point to the gentleman sitting right in front of you. Jayant represent ITC. And so I think it's a slightly more, I would say, let's take it offline. There is a role that CVCs play and there are challenges, so you have to balance it. But we have been doing some experiments. But he's the guy to talk to. I think to answer your first question, there is nothing sacrosanct about the 100 crores. I think the idea of having a benchmark when it says that this is a great proof point of that fact that there is consumer love, where we talked about customer trust, I would say trust then becomes love. And love then becomes the benchmark to say, can I now build a great business on this? Because I have some kind of confidence that there is a certain set of customers who love my business. So every sector, every business model will have that tipping point. So 100 crores is not the mark. I think why 100 crores become a number for investors like us is somewhere around that you start getting a sense that now a large business can be built. And our business model predicates on being able to invest more money to build large businesses. So as an entrepreneur, if you are saying, I want to build a great business, we talked about premium brands in the previous session, which can be a 30, 40, 50 crore business over the next 5, 7 years. And this is how I will build it with a very premium mindset. And it has a way of not just sustaining itself, but even as an exit, by all means. And I'm telling you, it's possible. But if you are saying, I have to go to a VC, I have to raise money, I have to build a business over the next 5 years, which should be a certain size of business, then there is a benchmark which we would look for to say, okay, now this is a trigger for growth and I want to put more money. So it's more the VC way of thinking. rather than yours. But for you, any business founder here has to have some definition of what that escape velocity or tipping point is, where I say I have enough confidence that now I can invest for growth and not invest for PMF.
I think we're done. Sorry. Thanks so much, Kaval. Thanks so much. Really interesting chat. Yeah.
Thank you. We would want you to stay back. Can we have a huge round of applause for these two gentlemen, please? Well, I would like Mr. Jain to join us onto the stage, please, to present a token of gratitude to both of them. Thank you. We will hear it one more time, please, ladies and gentlemen.